Want to generate consistent income without predicting whether the stock market goes up or down? Today, you'll learn one of Wall Street's favorite options income strategies, the Iron Condor.
So, what exactly is an Iron Condor? Well, it's a wildly popular, market-neutral options income strategy. Professional traders and institutional investors absolutely love this setup because they don't have to guess the market's direction. They just need the underlying stock or ETF to trade sideways, kind of just hovering within a specific range until expiration. Instead of making a risky bet that a stock is going to shoot to the moon or completely crash, an Iron Condor mashes up two credit spreads, a bear call credit spread and a bull put credit spread. By putting these together, you're literally profiting from time decay as the clock ticks down and from declining implied volatility, meaning the market expects fewer wild price swings. And the absolute best part? Your maximum profit and maximum loss are strictly capped. But for this strategy to actually be capital efficient, we need the right environment. The ideal market conditions for an Iron Condor? Range-bound markets with a very low directional bias. You want to jump into this trade when implied volatility is high at entry. Why? Because you want to sell those options when they're super expensive and then buy them back for cheap when that volatility inevitably drops. Also, and this is absolutely crucial, you have to trade this on highly liquid options markets. Stick to major index ETFs like SPY or QQQ, where the bid-ask spreads are razor thin. Section 1. The 4 option legs, structure explained. Think of this strategy like building an airplane. An Iron Condor uses 4 specific options contracts. They all share the exact same expiration date, but they have different strike prices. The main engine of your income comes from selling the inner strikes. You sell a higher put and you sell a lower call. That puts premiums straight into your pocket. But we have to protect that capital, right? That's where the wings come in. You buy a lower put to put a hard cap on your downside risk, and you buy a higher call to strictly limit your upside risk. It's a beautifully balanced structure.
Section 2, Step-by-Step Build, Constructing the Trade.
Let's walk through the exact blueprint step by step. Step 1, pick a neutral market or ETF expected to just trade sideways. Step 2 is huge. Lock in an expiration date that is 30 to 45 days out. Institutional investors prefer this specific window because time decay, which is your main profit driver, accelerates rapidly during this period, while still giving you a juicy option premium. Step 3, sell an out-of-the-money put. Step 4, buy an even lower put to limit your loss. Step 5, sell an out-of-the-money call for extra premium. And finally, Step 6, buy a higher call to lock in your upside risk.
Section 3. Real SPY example. Applying the blueprint. Let's make this real. Imagine the SPY ETF is currently trading at $620, and we have a totally neutral outlook. For our put spread, we're going to sell the 600 put and buy the 595 put for protection. Over on the call spread side, we sell the 640 call and buy the 645 call for protection. When you execute these 4 legs all together, you collect a net credit straight into your account immediately.
The math behind this strategy is incredibly straightforward. Your maximum profit, it's strictly limited to the net premium you received when you open the trade. That's it. On the flip side, your maximum loss is also completely defined. It is simply the width of your spreads, which in our SPY example is a 5-point difference minus the net credit you already pocketed. You know exactly what you stand to make and exactly what your worst-case scenario is before you even click submit.
Looking at the P&L zones here, your absolute maximum profit happens if the stock price closes dead center between your 2 short strikes at expiration. If it drifts a bit past your short strike, but hasn't crossed your break-even line, you still walk away with a partial profit. Losses only start if the price actually breaches those break-even points, and your absolute maximum loss only triggers if the stock massively surges or totally crashes beyond your long strike wings.
Calculating those break-even points is a total breeze. To find your lower break-even, just take your short put strike and subtract the total credit you received. To find your upper break-even, take your short call strike and add the total credit received. As long as the underlying price stays safely between those 2 numbers, you're making money.
Section 4. Greeks and Risk Management, Protecting Capital. If you're finding this guide helpful, don't forget to like, share, and subscribe to Fox of Wall Street so you never miss our latest investing and options trading tutorials.
Okay. Let's look under the hood at the option Greeks because they are the mechanics driving this strategy's profitability. Theta is a massive positive force for you here. Time decay directly pays the seller of an Iron Condor. Delta starts out near neutral, perfectly reflecting your sideways market outlook. Vega is negative, meaning falling implied volatility actually helps your position become profitable way faster. However, you've got to watch out for Gamma. Gamma rapidly increases your risk as expiration approaches, especially if the stock price starts creeping dangerously close to your short strikes. To survive and thrive, professional traders follow strict risk management survival rules. First, only trade liquid ETFs to ensure tighter bid and ask spreads. Second, avoid earnings announcements completely. Those large volatility spikes can easily blow right past your strikes. Third, and pay close attention here, close the trade early when you reach a 50 to 75% profit target. Cashing out early dramatically reduces your tail risk and your gamma risk. Finally, always limit your position size to protect your overall portfolio capital and keep a very close eye on implied volatility.
Section 5, Comparisons and Mistakes. Avoid rookie errors.
How does the Condor stack up against other strategies? Well, the Iron Condor offers medium income with strictly limited risk. Compare that to a short strangle. While it also has a neutral outlook and generates high income, the risk on a strangle is completely unlimited. If a stock gaps hard against you, a strangle can be absolutely devastating. Now, an Iron Butterfly offers higher income, but it requires the stock to close at a highly specific, super tight price target. And a covered call? That's inherently more bullish and carries the actual risk of stock ownership. The Condor shines precisely because of that beautifully capped risk profile.
But beginners still make some classic mistakes. The most common pitfalls? Trading illiquid options, where you lose cash just on the spread alone. Another huge one is ignoring implied volatility and entering when premiums are just too low. But the absolute biggest mistake is stubbornly holding the position all the way to the bitter end of expiration, just to squeeze out a few final pennies. Doing that exposes you to immense gamma risk. Add in oversizing your positions and trying to trade through chaotic earnings events, and you have a total recipe for disaster. Stay disciplined and avoid these traps.
Section 6, Summary and Takeaways, Mastering the Strategy.
Let's wrap this up. The Iron Condor remains one of the absolute most reliable option strategies for generating consistent premium income, provided you are in a range-bound market. You are literally generating income just by letting the clock tick, all thanks to theta decay. But remember, the real cornerstone of this strategy is strict risk control. Your long-term success isn't going to come from perfectly guessing market direction. It comes from disciplined strike selection, actively managing your Greeks, closing out at reasonable profit targets early, and protecting your capital above all else. But that begs the question, how do you adjust the Condor if the market suddenly turns against you mid-trade? Well, that's a puzzle for our advanced series.
Thanks for watching Fox of Wall Street. Subscribe for more professional investing, options trading, and stock market education.